Trying to bounce back after a brutal Monday. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Scarlett Fu. Matt Miller and Sonali Basak are off for the day. Bloomberg Open Interest starts right now.
Coming up, that $1 trillion wipeout driven by deep-seek pauses. But, shocker, Black Swan author Nassim Taleb warns that yesterday's sell-off, just a taste of what's to come. And even still, that market faces a big earnings test this week, with investors hoping and praying that results from the Magnificent Seven will restore confidence in the tech sector. Plus, we have that dollar on the rise after President Trump wants to impose across-the-board tariffs that are, quote, much bigger than the 2.5% that were just floated by Treasury Secretary Scott Bessent. All of that and more coming up. But let's take a look at where these markets are trading. You did see a lift pre-market, and we're trying to hold on here, but those gains coming in a little bit on the S&P 500, up about 0.1%. The Nasdaq 100, we had been looking at pre-market gains of about 0.4%. That's faded a little bit, but still green on the screen. Going to be really fascinating to see how that one develops. And then you train your eyes on the bond market right now. We saw that big rally come in yesterday as investors sought a haven anywhere they could find it. Not so much today. Yields rising a little bit, 2 basis points on your 10-year yield, but we're still below 460.
Yeah, a little bit of a give back there, and that's kind of the theme with some individual stocks that we're watching too. Nvidia shares inching higher after yesterday's historic sell-off prompted by concerns around AI competition from China. General Motors giving a better than expected profit outlook for the year. However, that guidance does not account for tariffs. Still, GM says it has a playbook if Trump adds tariffs to goods from Mexico and Canada. And shares of JetBlue plunging because its full-year costs are higher than expected. The airline says it expects a drop in flights for this quarter. Katie, a stark contrast to what we heard from Delta and American.
Yeah, absolutely. Looking forward to digging into those results, as well as Boeing a little bit later in the show. But let's talk a little bit about what's going on in these markets, because it was a brutal day across the board, from the opening bell to when you were on air at the close, Scarlett. And it's interesting. Usually we meet in the middle of the day on Mondays for ETF IQ. So let's talk about the flows.
Okay.
They were staggering. You take a look at the Qs, of course, that big tech ETF taking in $4.3 billion, biggest one-day inflow since 2021. So clearly, amid everything we saw yesterday when it comes to that sell-off, some investors saw opportunity to buy this dip.
Yeah, definitely people were buying the dip, and definitely people were taking the opportunity to buy up on what they considered safe havens. Consumer staples, healthcare stocks all did very well. Even within the tech space, you saw Meta climb to a record high because it's seen as a beneficiary of cheaper AI, and also its Llama AI model is also open source in the same way that DeepSeek is.
Yeah, it was fascinating. You saw Meta and Apple and yesterday green. Both of those companies report this week, so it should be a lot of fun. But let's start this show with politics, because we heard a lot from President Donald Trump yesterday saying that he wants to impose broad tariffs that are, quote, much bigger than 2.5%. Of course, that was the number floated by just confirmed Treasury Secretary Scott Bessent. And this really is just the latest signal in how Trump is preparing to reshape the entire U.S. supply chain. So let's break it down now with Anne-Marie Hordern. She is Bloomberg's chief political correspondent, also the co-host of Surveillance, fresh from the other set. So he talked about a lot. Of course, we heard about DeepSeek, we heard about tariffs and a few other things in there as well. I think we got to TikTok.
Tax cuts, deregulation, TikTok, yeah.
So pick your poison. I mean, it feels like we should start with tariffs, as that's what seems to be making its way through the currency market right now.
Definitely, and also the fact that he did float that February 1st, which is Saturday. It could be the first time we see these tariffs enacted on Canada, Mexico, and China. On China, it would be 10%. On Canada, Mexico, it would be 25%. But it's interesting because after he talked about tariffs as well in this speech in Florida, which he talked about aluminum and copper and semiconductors and pharmaceuticals, he was asked on Air Force One about this Financial Times article that allegedly the just confirmed Treasury Secretary Scott Bessent is floating this idea of a gradual, almost forward guidance, 2.5%. Now, this does ring true to Bessent's thinking, because in August, he told us on Surveillance that potentially that would be the way to look at tariffs. 2.5% for 2 years. Xi Jinping, tell us when it starts to bite before you get to that 60% on the campaign trail Trump was talking about. And when Trump was asked about this, he said, no, actually, it's going to be bigger. And then he said, I have the idea and the number in my head, but I'm not ready to set it. So it's kind of like, he said at the debate, I have concepts of a plan, still is being worked out. And I think that's probably appropriate in the sense that this is only the second week of this administration. He doesn't even have his commerce chief in place. We're still waiting for his entire cabinet to get confirmed. But I think what is so important about it is potentially you'll hear more about this because Saturday is that date he at least marked on the calendar.
Also, not going into detail works for him, right? Because the broader the threat, the broader the concessions he might be able to ring as well.
And we saw that over the weekend with Colombia.
Absolutely. Something else that is not getting perhaps as much attention is how Trump paused all federal spending on loans and grants. And this seems to apply to things like non-government organizations, foreign aid, DEI. I mean, it's the whole gamut, really.
I think a lot of this is that this administration promised to come in and review what had been done over the past 4 years. I think that's what they're doing now, putting a pause on everything till they get all their people in place. And then potentially we could see some more of these loans and grants come back out. But yeah, at the moment, all of that is stopped. But potentially, I would say, just watch this space.
All right, Anne-Marie, that's a good place to leave it. Great to see you. Of course, that is Bloomberg's Anne-Marie Horder, our chief political correspondent. And let's broaden out this conversation now with Emily Bowersock Hill. She is CEO and founding partner of Bowersock Capital. And what we also heard from President Donald Trump yesterday was that the release of DeepSeek AI should be a wake-up call for American tech companies. And you write in your notes that this AI reckoning that we saw on Monday was overdue. If that's the case, do you think that we're through it, or is there still more pain to come?
Well, frankly, I'm still processing it. I think if China has truly learned to develop a powerful AI model with a fraction of the budget and much less infrastructure, that would be a pretty significant shock. I think I heard out of the corner of my ear on Bloomberg yesterday, and I apologize, I don't remember the person's name, but he was talking about it would be like a big pharma company who had spent billions on R&D, suddenly having a competitor come along and manufacture the same drug at a fraction of the cost. But at this time, we have no patents. So I do think this is something that the market's gonna have to digest. I hope it's a speed bump. Certainly, we're still gonna get a significant productivity boost, in my opinion, from AI. So it's really the chip makers and the equipment makers that are going to struggle. But I think the market's going to have to process this.
Yeah, I appreciate your being candid about that, about something that the market needs to process. It's not just a one-day knee-jerk reaction. How does this color your interpretation of the earnings that we're going to get this week from the big tech companies, from Meta to Microsoft to Tesla?
Well, I think there's going to be even more scrutiny on them. With the exception of Apple, we expect big tech earnings this week to fall in line with expectations. And, before yesterday, Apple had dropped 11% year to date. We saw both Meta and Apple actually up yesterday, as you pointed out earlier in this show. So, I think given the high valuations of mega cap tech, I would certainly not expect a price boost from earnings unless we see, some kind of significant earnings surprise. I think we just have to hope that we get through without some sort of unexpected negative news.
Can we talk a little bit more about Apple? So you're expecting big tech earnings fall in line with the exception of Apple. Is that to the upside or the downside for Apple? Because Apple certainly has had a brutal start to 2025.
Brutal. I would expect if there's a surprise, it's probably going to be a downside surprise just because of all the issues they have with China and competition from various Chinese smartphone producers. And so I think, Apple has been seen as a defensive stock, and it's the go-to when, people are scared, as we saw yesterday. So I think we could get a negative surprise from Apple. But I think, again, some of that is baked in already. That's why Apple was down over 10% year to date. That's known.
That's known, yeah. So these are all things that are going to play out over time. And I think about how General Motors gave an outlook that was not incorporating the potential tariffs. And I guess they can't really say anything because nothing has been explicitly pledged just yet. How helpful is it to hear company executives talk about the known unknowns, but not be able to put any fine numbers to it?
I think it's tough. Global stock markets have not yet priced in the impact of tariffs, in our opinion, and that's because the policy particulars are still unclear. And also, it's extremely complex. We haven't really seen the market react to tariff threats. We've seen reactions in the currency markets. We've seen some reaction in the bond market. But I think, frankly, at this point, until we have some more specific policies, it's very CEOs to be candid about that. Who knows?
All right, Emily Bowersock, we are having some communication issues here. Let's leave it right there right now with Emily Bowersock joining us here on the market, CEO and founding partner of Bowersock Capital. Let's get a look at some of the individual stocks that are currently moving ahead of the opening bell right now and bring in Bloomberg's Isabel Lee. Isabel, a lot of earnings that we got this morning.
Definitely a lot. I'm looking at Boeing. So shares are now edging flat, but this is interesting because we have the CEO, Kelly Ortberg, saying a recovery plan is in place. And this comes after the company posts its 6th consecutive annual loss. So we know that Boeing burned through some $14 billion of free cash during a really challenging year. It's been marked by near catastrophes, leadership turmoil, federal investigations, and lengthy worker strike. The CEO actually was a longtime aerospace executive who Boeing hired out of retirement over the summer. And it's made progress, but that will take time, of course. In Royal Caribbean, it's up around 4.5%, at least in pre-market trading. The company reported adjusted EPS that beat analyst estimates and extended its streak of quarterly profits. So the firm said its busiest season is looking good. It's called wave season. And wave season is when cruise promotions peak, and that's during the first quarter. So people are definitely back cruising, and they also have an initial order of 10 river ships. So that's a luxury cruise. That's their new thing. So that might catch some excitement. And lastly, we're ending on a slightly down to flat note. AMD is edging a little bit lower, down by 0.03%. The stock is downgraded to hold at Melius Research. The company sees earning risks given competition with NVIDIA. And the firm has a 2-year price target of $129 for the stock, but that's down from $160. So that's 3 I'm looking at, Scarlett and Katie.
All right, Isabel, great roundup as always. We'll see you a little bit later in the show. And let's take a look at these markets right now. Less than 20 minutes ago until the bells ring. You can see still some green on the screen, but even from when we checked markets 10 minutes ago, some of those gains coming in right now. The S&P 500, the Nasdaq 100 up about 0.1%. The Russell 2000 actually lower on the day. It was your relative outperformer yesterday, but that even is a generous term given how brutal the sell-off was yesterday. And Scarlett, it was interesting. I mean, this time yesterday, we were talking about how there's a lot of daylight between the open and the close, and that maybe we could see a rebound by the end of the day, but you were on the close and it didn't happen.
Well, we did see a rebound in things like the Dow Jones Industrial Average, which is price weighted, so it's not as accurate a reflection of the overall market.
We ignore that on this show.
I noticed that it wasn't on your market check, but it's interesting that today, when you look at futures, Dow futures are lower, so a little bit of a reversal from yesterday's trade. Worth mentioning as well that today is day 1 of the FOMC. We're not going to get anything out of them today, but even tomorrow when they come out with their decision, the decision is no change in interest rates. It's how Jay Powell talks about inflation that matters.
That's true. That's true. Of course, there's what happens at 2 p.m. and then the real trade comes through once Jay Powell actually starts speaking. Much more ahead, though. We're going to talk about NVIDIA bouncing back in pre-market trading, but still a ways to go to recover from yesterday's DeepSeek-fueled drop. It fell 17% yesterday alone. More next. This is Bloomberg.
Now to high interest, it's a look at what's making headlines around the world. Scott Bessent has been confirmed as the next U.S. Treasury Secretary. He won confirmation in a Senate vote that went 60 to 29 in his favor, including support from 15 Democrats. The former hedge fund manager's policy objectives include 3% GDP growth, and reports indicate that he wants to start universal tariffs on U.S. imports at 2.5%. Now, an internal memo to staff, HSBC says it will wind down some of its investment banking operations in Europe and the Americas. Instead, HSBC will focus more on Asia and the Middle East. It's part of the CEO's ongoing restructuring of the lender. An HSBC spokesperson did confirm the contents of the memo. And billionaire investor Ray Dalio says today's AI frenzy looks a lot like the dot-com surge of the new millennium. The founder of Bridgewater Associates telling the Financial Times pricing has gotten to levels which are high at the same time as there's an interest rate risk, and that combination could prick the bubble. The Nasdaq 100 doubled in 1999 before falling 80% in 2002. The same index has again doubled since the start of 2023. All right, let's get you a check on the pre-market AI trade right now. NVIDIA recouping some of its losses after shedding $500 billion in value yesterday. DeepSeek's release of its AI model has forced a re-evaluation, I should say, of the economics of building AI, with some arguing that the focus should shift from spending heavily to developing more efficient techniques. Bloomberg Intelligence senior analyst Mandeep Singh is here. Mandeep, clearly DeepSeek is causing a rethink here, but is it still too early to determine winners from losers? When we saw Meta, for instance, rise and Apple rise yesterday, is that people determining winners versus losers versus just, trying to find some shelter from the immediate fallout?
Yeah, I think the theme of generative AI and building large language models is still intact. I mean, you will still see a lot of money flow into it. But the question remains, where are the scaling laws going to hold? And will the focus shift towards algorithms now, given what DeepSeek has shown is really you can use algorithms to build a more efficient model when it comes to utilizing your hardware? I mean, for the last 6 months, it was about just how big of a cluster can you build? Will the next version of the model have more parameters? And just scaling it through hardware. Now that brute force approach will probably go away. It's more about, can you come up with a better algorithm to use the tokens in a way where the query is more efficient, the pricing per token is more efficient, and just utilize your hardware more efficiently. So I still think everyone wants to deploy generative AI. This has just shifted the focus away from the chip makers and the scaling of data centers to more applications and really making it cheap for those guys to deploy generative AI at scale.
Well, I love that you call it, this brute force approach, because up until Friday, it felt like it was just a contest of how much money could these big tech giants spend and devote in terms of their capex. But talk to us about what this means going forward, not just necessarily DeepSeek's AI model, but what it represents in terms of how some of these companies, how the OpenAIs of the world are going to approach how they build out their models.
I mean, I expect OpenAI will open source at least some of their models. Just looking at how successful DeepSeek is in terms of, getting all the attention and the fact that their training run costed $6 million. I mean, it's in OpenAI's interest that the world uses their model. How do you really spread your ecosystem and really make sure that everyone is using their model? You make it open source. That's what Meta Llama did. I mean, obviously, they were not at parity with OpenAI and Anthropic Claude models for a while. But what DeepSeek is saying is you can be innovative with your architecture and come up with better pricing. And that way you can open source your model and find other ways to monetize it. But clearly, that LLM layer will get commoditized slowly. That's the message here, given what we are seeing with DeepSeek.
So Katie mentioned the big capex that's being devoted to building out AI. $65 billion for Meta this year, about $80 billion from Microsoft this year. Are those still the right numbers to be looking at? I mean, are they going to start updating that or tweaking that, or at least even talking about tweaking those numbers given what we've seen with DeepSeek?
So what I want to know is how much do they want to spend on training versus inferencing? Because right now, everyone thought the next training run for GPT-5 is going to cost $1 billion. For Meta Llama, it's going to cost close to $1 billion. This is just training the LLM. Inferencing is where you deploy it in applications, and that's where everyone wanted the latest NVIDIA GPUs because you want to train your LLM with the latest chips. Now suddenly the focus has shifted to inferencing because you can do a lot more with your existing chip infrastructure. So the numbers for this year still look good. My question is more around 2026 and 2027, given AI will really scale. I mean, we know this will get deployed across applications, but do these companies need to really invest in the cutting edge GPUs and really buy the scale that they were allocating right now? Probably not. And I think that's what we'll find out with the earnings season when these companies report their results.
Just to finish on the competitive landscape, I thought it was interesting to see Sam Altman, of course, of OpenAI, tweet yesterday, quote, "We will obviously deliver much better models, and also it's legit invigorating to have a new competitor." Those are his words, not mine. I just thought, I mean, what else could he say at that point? But we heard from Donald Trump yesterday, too, saying that this should be a wake-up call for U.S. firms. Do you think that it is, or do you think that some of this management is trying to talk down maybe some of the impact here?
I mean, everyone has acknowledged this, and I go back to, the Project Stargate announcement, $100 billion with outside investments from Masa and, SoftBank. A lot of it was going towards training the next version of the LLMs. Now they have to decide, do they spend so much money upfront, or they invest more in, test time compute and inferencing, because that's what I think DeepSeek has shown. Companies can do more with inferencing than they need to do in pre-training. And I think that debate to me, is crucial in terms of how the CapEx gets allocated going forward.
Well, I'm sure you can't wait for some of those earnings calls to start to roll in. Pretty exciting stuff. Mandeep Singh of Bloomberg Intelligence, just a masterclass this week. And coming up, Nassim Taleb tells us that the NVIDIA rout is only the beginning. More on his remarks later this hour. This is Bloomberg. All right, welcome back to Open Interest. A quick check on where we stand. Of course, minutes away from the opening bell. You can see, again, that lift in markets. It's tepid, but it's there. The S&P 500, the Nasdaq 100 higher by about 0.2%. It certainly helps that NVIDIA is currently more than 3% higher in the pre-market. The Russell 2000 trying to decide what to do on your small cap index, currently unchanged. But again, trading hasn't even started. And with less than 4 minutes until the opening bell, stick with us. We'll discuss the market moves with Ben Laidler. That conversation coming up next. This is Bloomberg. All right, we are moments away from the start of trading on this Tuesday. Welcome back to Open Interest. I'm Katie Greifeld, and of course, we're looking at a much different picture in the immediate pre-market than we were 24 hours ago at this time, when that DeepSeek news really sent shockwaves through the entire tech, AI, and chipmaker complex. You can see green on the screen behind me right now. Investors choosing to buy the dip yesterday in a big way. You can see that in the ETF flows really across the board. Now the question becomes, of course, do you fade this bid, or do you keep hoping that momentum will return to this market? A lot of big questions facing investors right now as we head into earnings and we head into the Fed tomorrow. Of course, maybe a little bit of a forgotten catalyst given all the drama that we've seen this week already. But about 22 seconds into the trading session, you can see that the bells are ringing down at the Nasdaq, down at the New York Stock Exchange. Plenty of enthusiasm there, and a little bit of enthusiasm as it comes to the first 32 seconds of the trading day. The S&P 500 higher by about 0.2%. Big tech trying to lead the way here, currently up about 0.3% on the Nasdaq 100, but wavering around. A lot of that is thanks to NVIDIA. I will get to that in a second, but pour one out for the small caps here, trying their darndest to get in on the action as well. They were the relative outperformer yesterday, but it was just an absolute bath across the board. But at least for the Russell 2000, at least for right now, higher by about 0.2%. Let's take a look under the hood here and take a look at the chip makers, because NVIDIA, Micron, and Broadcom all rebounding right now after a brutal session yesterday. Traders really focusing in on big tech earnings now, and any news we might get about AI spending strategies when Tesla, Meta, and Microsoft all report tomorrow. Scarlett, it's going to be a fun one.
It's going to be a fun one indeed. All right, let's talk about some non-tech names. General Motors giving a better profit forecast than many on Wall Street had expected, but the outlook does not account for potential tariffs on goods made in Canada and Mexico. The car maker does say it is preparing for any tariff surprises. And JetBlue reporting a smaller than expected loss for last quarter. The stock currently down 17% in early trade, but its forward guidance disappointed. JetBlue anticipates operating fewer flights in the first 3 months of the year as that turnaround effort continues. But the main story, of course, today is the volatility we're seeing in the tech sector, at least at the start of the week. Bloomberg Technology co-host Caroline Hyde is here now to discuss. And Caroline, it was all about seeking shelter, seeking some kind of safe haven from the DeepSeek news yesterday. And I guess investors kind of found it in Meta as well as Apple. What is the safe haven here within tech? Certainly away from chip makers, isn't it?
It feels as though software suddenly becomes the beneficiary of AI getting cheaper and cheaper, and the hardware infrastructure is a key question. Look, I'm surprised at how little NVIDIA is rallying right now. We're clawing back about $68 billion in market capitalization when it lost more than $600 billion in market cap yesterday. So clearly people are still sensitive to the idea that DeepSeek is managing to, with lower grade chips, yes, still NVIDIA chips, but not the H100s that we also used to here in the United States, managing to create deeply effective, efficient, powerful models are one. In fact, DeepSeek's just dropped an image generator as well, so the narrative just continues here. And I think, though, Meta was a key outperformer, not only because I think this is going to help in terms of their advertising models, generative AI gets cheaper, they can do more with less, but also they've led the way when it comes to open source model creation as well. So that also steals a march for them a little bit in terms of the narrative.
I agree with you on NVIDIA. I mean, we spoke to CJ Muse over at Cantor Fitzgerald yesterday, who is in NVIDIA bull, to be fair, but his point was basically that this is all good news for NVIDIA because AGI is closer. It's not further. But in any case, of course, we're sitting at the precipice of really the heart of earnings season. We have a ton coming up in the next couple days, including Apple on Thursday. What do you think that people really will be listening for on the earnings calls? It feels like it's all we're talking about.
CapEx, CapEx, CapEx. How much are you spending? And I don't think you're going to hear them backing away. Microsoft has said they're committing $80 billion in terms of data center spend. Now, you're going to hear a lot about Jevons paradox suddenly, this idea that more efficient you get
that.
about coal and basically the fact that we got more trains, more efficiency, but you still needed more coal. The more efficient AI becomes, the more data centers you're still ultimately going to need. This was also what we heard from ultimately a spokesperson coming from NVIDIA. They were saying, look, this is good for us because it's not all about training your models that, yes, clearly R1 was very cheap at doing. It's about inference here. It's about using the models. We just saw yesterday, perhaps there was a crackdown in terms of some sort of malicious attack on DeepSeek and why you couldn't sign up to it. And maybe it's also they didn't have enough cloud provision. And then also, to get the answers to your questions, you need a lot of data centers and compute. So this is still the argument coming from Jensen and the likes from NVIDIA, and indeed you'll hear it from Microsoft. The cheaper it gets, the more efficient it gets, the more you and I use it, the more we're going to need compute.
It's just more good news as far as Jensen Huang is concerned. Is he on the calendar, to do anything, speak at any conference anytime soon? Because I know his earnings doesn't come till much later in the cycle, but whatever he says right now is going to be top of mind and steal the focus from everyone else.
February 26th, we've got to wait for their numbers. And that's always the way, and that's why this week we start to try and read the tea leaves. What is Satya going to be saying? And of course, Amy Hood, the CFO, going to be saying about their spend on data centers, on GPUs. What is Amazon going to be saying? What is Microsoft, as I just mentioned, going to be saying? What's Meta going to be saying, and their commitment to $65 billion, and how much of that spend is about GPUs coming from NVIDIA? I think we managed to draw out that if they remain committed to CapEx, so too NVIDIA continues to win in the short term. This is a longer term train that we're going to have to be navigating.
All right, Caroline, great to see you, of course. Caroline Hyde, she is the co-anchor of Bloomberg Technology. That's at 11 a.m. Eastern. It's a must-watch show in any case, but especially this week, given all of the drama that we're seeing in the tech sector. Let's take a quick beat on Starbucks here. Starbucks reporting after the bell today, but we have some news out from CEO Brian Niccol working to reinvigorate sales at the company and replacing two top executives. The president of North America and the chief supply and customer solutions officer are leaving Starbucks. This is according to a statement today. And again, we're looking ahead to earnings after the bell. And Starbucks, of course, has been a very tough story.
It's been a tough story. It's in turnaround mode, and Brian Niccol is starting with the little things, right? Making sure that customers who are in store get a ceramic mug as opposed to a disposable cup, trying to make sure that the store personnel greet customers when they come in, ask them if everything's okay. There's a lot of Q&A and surveys with customers. So he's getting the small stuff right, making sure that Starbucks remains a hospitable place for customers before moving to tackle some of the big strategy issues. Investors are giving him quite a bit of space to do all that, but at some point they're going to want to see results.
That's true. I mean, a lot of hopes and dreams pinned on Niccol given the job that he did at Chipotle, but we'll see how long that patience lasts. But let's broaden out now and welcome in Ben Laidler. He is Bradesco Securities head of equity strategy. And I won't ask you about your Starbucks order, but I am interested about what happened yesterday and what your read of was when you think about DeepSeek, their cheaper AI model, and all of the question marks that are around these big CapEx plans from a lot of the U.S. tech giants. Did anything fundamental change for you yesterday?
Well, the market certainly gave itself a collective heart attack. It's not every day you see 30 large caps down 10% or more. But your point, I think this tells us more about crowding and more about the high valuations in some bits of the US than it really does, about the fundamentals. I mean, this has been a sort of one-way freight train for a couple of years now. It's sucked in an awful lot of capital. It's taken valuations to quite high levels. I don't have a problem with them, but they are objectively high. And I think we had a little bit of a reality check yesterday that, maybe tech disruption is not a one-way street, but I don't think the fundamentals have maybe decisively changed for big tech.
Yeah, it's a great point. Maybe the fundamentals didn't change, but certainly the valuations under a microscope right now. And with valuations, it always feels like they don't matter until they do. And yesterday, they certainly mattered. Do you think that they will continue to matter in this market? Is there more pain, more indigestion to come?
Listen, I think big tech is fine, but I think the real opportunity is everywhere else. And our narrative has really been this bull market broadening out. It's been a bit of a one-legged stool so far. It's all been about the Magnificent Seven and the broader tech sector. I thought it was very interesting yesterday that value, you mentioned small cap, rest of the world, they really picked up the baton. I think that's extraordinarily healthy. I think a little bit of interest, a little bit of money will go a very, very long way in some of these other assets. They've got very small and very cheap, but I do think they are the sort of canary in the coal mine for a healthy broadening of this bull market.
Yeah, people talk about that a lot, this broadening out, and finally, perhaps we're seeing it with some distress coming to tech first. I look at the VIX, currently below 18 after surpassing 22 yesterday. Still, at yesterday's close, it was the high since the December 18th Fed decision that sparked that big sell-off. Feels like volatility is the new normal now. Is the volatility a good thing for a stock picker?
I think so. And, 20 is basically your long-term average. So, it's taken us a few years to get here. But, this is what we were used to living with until, the last few years. And I think the combination of the fact that big tech may not be a one-way train anymore, the new administration, the potential threat of tariffs, to which we may get as soon as Monday. We have a Fed meeting. I can go on and on and on. And there's plenty of reasons, I think, for this new normal, which I think is absolutely right, of stock market volatility.
All right, speaking of the Fed, Jay Powell, will be taking the lectern tomorrow at 2:30 p.m. We know his comments last time around did spark a decline in asset prices. What will you be listening for when it comes to anything he betrays on inflation? Because obviously he's hamstrung by the fact that there's not a whole lot of policy to respond to so far, right? There's a lot of general vague threats about tariffs, but no details to really work your way into models.
I think he's going to try and take a punt. The latest inflation number has been, reasonably, benign. There's obviously a lot of macro uncertainty, ahead of us. I think he'll try and give a sort of open-ended statement. But I think, the market's already moved quite aggressively, I think, to pricing, basically no more cuts or maybe one more cut. But I think the risks are elsewhere. It's this one-legged stool of big tech. It's potential tariffs coming on the rest of the world. It's that policy mix. I think for once, and touch wood, I think the Fed will take a back seat here.
Well, Ben, that's where I wanted to go. Basically, what are the catalysts of this market? Touch wood, like you said, the Fed seems to have taken a back seat. But, if we start to really reassess that rate cut picture, could that overwhelm what we're talking about when it comes to politics, when it comes to earnings season as well?
I think ultimately this comes back to earnings. With what we know now, we're on track for the best earnings season in the US in a couple of years. Earnings are accelerating, earnings are broadening out, margins are remaining, extraordinarily resilient. I think that is the focus. It's going to take quite a lot of other stuff, I think, to really push that off track.
All right, Ben Laidler, thank you so much for joining us. Ben Laidler with Bradesco, giving us an outlook into what we can anticipate, earnings driving everything. Coming up, speaking of earnings, GM tops profit estimates, but the stock slumping more than 8.5%. We take a look under the hood next. This is Bloomberg.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Roper Technologies upgraded to buy from hold over at TD Cowen. The analyst says that the software firm's U.S.-centric portfolio could be attractive to investors. Next up, we have Barclays upgrading Victoria's Secret to overweight, saying they have confidence that the new CEO is the right choice to lead the lingerie company's brand revival. Shares up almost 4%. And finally, let's end with Ciena, raised to overweight over at JPMorgan. The analyst is saying that yesterday's sell-off of the communications tech company offers an entry point into better near to medium-term momentum. And another stock we're keeping a close eye on this morning is, of course, General Motors. The stock falling sharply after this morning's earnings report, even though the automaker announced better than expected profits in the futures, but it did not take potential tariffs into account. Here with more, I'm pleased to say we have Bloomberg's Detroit bureau chief, David Welch. So tariffs feels like a pretty big thing to leave out, David. Did we hear anything more in terms of detail on the earnings call?
What they said is they have contingency plans, they have things that they can do. They didn't give a lot of detail on that, and I think that's what investors are reacting to. General Motors gets about 22% of its U.S. sales from vehicles built in Mexico, and they've got pickup truck plants. It's its most profitable vehicle line. They've got them in the U.S., of course, but they have a plant in Mexico, another one in Canada. So you're talking about volume on their most profitable, highest volume vehicles, potentially being subject to tariffs. And all of that kind of gives a potentially cloudy future here for earnings for the next few quarters until this whole tariff situation between the Trump administration and the other USMCA countries gets ironed out. So you have that really hanging over the stock. And the other thing is, the upgrade on the high end was an addition of about $700 million in operating profit this year. That's very good, but most of that, $500 million of it, came from the elimination of Cruise. That tells you that the rest of the business is solid. You're seeing improvement in China, you're seeing strong pricing and good sales in the US, but it's not enough to overcome these other potential headwinds here. And it just shows that their core business is stable, growing a bit. Pretty good, pretty solid, but who knows what's going to happen with tariffs, and that's got everybody on edge right now.
Yeah, it leaves GM in an unenviable position, which is the things that it can control, it's doing, it's executing on, but there's too much that's really left to Washington and what may come, and it really has no ability to manage any of that. Having said that, what does the business look like on the whole in the United States, which is, of course, now that it is improving in China and recovering a bit there, the U.S. remains its biggest market?
It is, and in the U.S., GM has kept up pricing in the fourth quarter. Sales were up 21%. Those are all good things. Some of their competitors are discounting in the U.S., adding rebates. They've been able to avoid that so far, and they think they can for a while, although they're acknowledging that they could see some price pressure this year. The other good news for them is they're starting to mitigate losses, and in fact, getting to variable profitability on their electric vehicle program. But there, too, they say that the biggest drivers of reducing losses and getting to a operating profit on the electric vehicles is scale. That means more sales. And if the Trump administration gets rid of or at least greatly reduces the tax incentives, that again, that's another issue that could be a headwind for GM this year. They'll probably still grow sales in their EVs. They'll continue to get scale, but it could slow down their march toward making that a totally profitable program.
All right, David, appreciate your reporting. Of course, that is Bloomberg's David Welch on a terrible day for General Motors, currently down about 8.5%. It was one of the automaker standouts last year, but can't say the same today. Let's check in on Boeing quickly, though. Of course, they reported earnings this morning. You can see shares flying on a relative basis relative to Boeing's recent history, up about 4% right now, actually foregoing setting financial targets for 2025. But we did hear from new CEO Kelly Ortberg saying that he's optimistic about returning to a production rate of 38 737 aircraft per month this year. Scarlett, talk about a turnaround story. This is one that investors have been watching super closely.
Yeah, 6 years of losses over at Boeing. This is clearly a long-term turnaround story. Nothing's going to happen right away. And even to that end, with Kelly Ortberg addressing these needs to invest in core businesses, perhaps, paring down the unprofitable businesses. He's not saying a whole lot of detail on that. It's still a work in progress here. And the big question is what happens with demand for the jets? And that is a good news story because there's not enough supply of these jets.
No, not at all. So we'll continue to follow that one. Just one of the many things that we're keeping an eye on.
All right, coming up, we've got Nassim Taleb saying NVIDIA could see further losses 2 or 3 times what we saw yesterday. That was a 17% plunge. We've got more in our Wall Street beat. This is Bloomberg. Time now for the Wall Street Beat. Black Swan author Nassim Taleb says the steep sell-off in Nvidia shares yesterday exposes the market's reliance on a few names, and he warned of more losses ahead. Look at Nvidia right now, Katie. Unchanged. It had opened and gained as much as 3.2%, but it's now teetering around. So this recovery that we're anticipating may not come to fruition.
Yeah, it's pretty nerve-wracking here, and I don't know, maybe it adds some weight to what Nassim Taleb is saying here in terms of more losses ahead. He, of course, spoke with Sonali Basak on the sidelines of Miami Hedge Fund Week.
Nvidia went up from something like 12, 13, 14, 18, all right? Went up in order of magnitude. So giving back 17% is not large. It's just a small setback.
Why do you think it was such a sharp sell-off? Was it market structure and too overcrowdedness in one name? Or was
everybody
fundamentals?
focuses on the same story, and people notice the falls more than the rises. Okay, they found it natural that the story would work, that Nvidia would keep rising, and unnatural when it pulls back a little bit. It pulled back, very little considering the risks involved in such an industry. You're building everything on the hope that people will use your chip, will use chips, and that the investment will not come from software or someone figuring out a better idea or some other method, and which is what happened. It's a hint of what is to come.
Well, are you saying that there could be a lot more in terms of a drawdown?
I think that the over-reliance on that story of, number one, you're going to be the one making money from AI, NVIDIA, not others. This over-reliance is completely at odds with our knowledge of history, all right? The one who came up with the first laptop computer, Sir Clive Osborne, went bankrupt. Okay, the one who, look at history. Those who come up with a new technology, they think, hey, you know what? We figured out this is going to be the future. We own the future, and sure enough, okay, someone else will make the money.
All right, that was Nassim Taleb speaking with Sonali Basak in a very Miami setting. Of course, the music and the setting didn't quite match up with what he was saying because it was pretty doom and gloom when it comes to what we could see in terms of more pain on this NVIDIA story.
Yeah, he felt very comfortable sitting there, in the Miami heat with the jolly music talking about what he expects. He calls tech firms gray swans because investors underestimate the possibility of one-day deviations in their prices of the likes that we saw yesterday in NVIDIA. $589 billion in market cap lost just in one day.
And gray swan seems generous from him because a lot of people were saying that yesterday was the black swan moment for AI. It wasn't even something that a lot of people had on their dance card. We heard from Ruth Porat over at Davos last week saying that China was maybe a year off from American AI models or something to that effect. And maybe even that timeline is is being questioned right now. We'll continue to follow, of course, what's going on in the market, what's going on with NVIDIA, trying to decide whether it wants to go higher or lower right now. You can see the S&P 500 taking a leg lower, down about 0.1%. The NASDAQ 100 trying to hold on to gains. Stick with us. Coming up in our next hour, we'll speak with Grace Peters. She is JPMorgan Private Bank Global Head of Investment Strategy. This is Bloomberg. All right, we are 30 minutes into the Tuesday trading day. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Scarlett Fu. Matt Miller and Sonali off for the day today. Sonali Basak, sorry.
Yeah, that's her name. Let's take a look at markets right now. Of course, we are waiting for some economic data, which will be a nice something different given that we've all been so focused on AI. Taking a look at the Conference Board consumer confidence figures for January coming in at 104.1. That is actually lower than the survey and lower than the prior reading. The survey was looking for 105.7. The prior reading was 104.7. So disappointing a little bit relative to recent history. Again, the consumer confidence board, the conference board consumer confidence reading for January coming in at 104.1. Let's break it all down now with Mike McKee. He knows all these words very well. Mike McKee, you take a look at these figures. You think about the Federal Reserve meetings that's kicking off today in Washington. How does this fit into the broader picture that the Fed is assessing right now?
Well, confidence is really misleading in the sense that it doesn't really tell us what consumers are going to do. It tells us how they are feeling. One of the interesting questions is going to be about buying plans, and the Conference Board report doesn't come out immediately with the breakdown as it used to, but basically purchasing plans, it says for homes and cars were flat in January and flat for most appliances. Now, some of the other indicators have suggested maybe people wanted to start buying ahead of tariffs, ahead of prices going up. So that doesn't quite validate that theory. But inflation expectations do matter to the Fed in these numbers. It's not the same as the University of Michigan that gets all the publicity, but their average 12-month inflation expectations increased from 5.1 to 5.3%. Pay no attention to the number itself because Americans aren't very good at guessing what inflation is, but the fact that it is going up matches what we have seen in other surveys. So that might be something that concerns the Fed.
You know, speaking of prices going up, we had the S&P CoreLogic housing price index come out, and that indicated prices are moving up for housing, as at the same time that mortgage rates are climbing as well.
Yeah, we had seen a decline in the rate of increase in home prices, but that has apparently stalled, or at least did in November. Remember, these are 2 months delayed. So we'll have to see if those come down in the future. The rent numbers have been coming down. That suggests that housing overall in the CPI will come down because that's what they use rather than home price numbers. Might mention also the Conference Board present situation number, 134.3, way down from 140.2, and expectations do rise, 83.9 from 81.1. So people don't like where we are right now with inflation coming down, unemployment low, and growth strong. But they think things are going to get better.
Yeah, it's always something, isn't it? Mike McKee, great to see you before you're heading to D.C. for the Fed meeting.
Yes, we will be there tomorrow.
We will see
you have your question ready on inflation?
Everybody wants to know, how do you pose a question to Jay Powell about Donald Trump when you know he's not going to answer?
Yeah, that's the art of journalism, isn't it? Mike McKee, great to see you. We'll be speaking with you tomorrow, of course. Let's broaden out this conversation now, though, with Grace Peters. She is JPMorgan Private Bank Global Head of Investment Strategy. Grace, great to have you on set with us.
Lovely to be here.
So, you know, coming into this week, I might have asked you about earnings. I might have asked you about the Fed, but I'm going to ask you about AI and what we saw yesterday, that broad-based sell-off. Were you just fielding phone calls from nervous clients? How did it actually feel from where you were sitting?
AI has been a huge theme of ours, and it continues to be. So our conviction has not changed because of some volatility in markets. Indeed, one of the key themes that we've been talking with clients through the course of this year is that they should expect more volatility, particularly equity market volatility. We've seen a fair amount of rate volatility over the last 12 months, but equity volatility has been extremely benign, and we should expect more. As it pertains to AI, as I say, it's still a key theme for us. We are employing AI in our business. We can see transformative impacts, and we do believe this is going to be a really positive thing for the economy. But there's a whole AI value chain, and I think, Scarlett, to the point you made earlier, investors are just too concentrated in one part of that, whether it be the hyperscalers or AI infrastructure. I do think there's also a positive story that could emerge about AI adoption here. That means when we think about that value chain, you want to focus more on the applications, on the revenue beneficiaries, because ultimately, if this technology is embraced with a faster J-curve, that is going to be positive for the economy, for the US economy, perhaps for the developed world and economy at large, which I think is positive for equity markets. So yes, fielding lots of calls, but I think not panicked, but in the context of building portfolio resilience.
Yeah, and to that point, a lot of people are saying names like Salesforce.com and ServiceNow are beneficiaries here of the cheaper AI models. The thing with looking at big tech names, and NVIDIA in particular, which is now up by about 1.5% at the moment, is that so many people use them as a safe haven in their portfolios as well. It wasn't just the growth component, it was also their utilities, their modern day utilities in many ways. Do we need to rethink that given the expectation for greater volatility in these names?
So I think, why would they use it as a utility? It's because of the cash flow generation. If we think about even, without even focusing on one name, the largest 10 stocks in the S&P, they are spending around 41% of total S&P R&D expense. So we know that they're investing for the future, but they're also generating over 25% of cash flow. Despite that investment, they can afford to pay dividends and they can afford to do share buybacks. Indeed, of the S&P's overall 1.2 trillion, over 30% of share buybacks will come from these 10 large companies. So that's what makes them, actually a quality defensive ballast in the portfolio, as well as obviously growth stocks. And that would be one of the reasons that I'd say we don't need to panic here. Sure, the focus of the market through that AI value chain may shift, as discussed, but I think the cash flow generation and the reason why we want to invest actually in listed companies, quality listed companies with the balance sheet, is one of those reasons why I think that, no panic, and actually some of those stocks will prove to be a good entry point.
I'd love to bring this conversation to the bond market because honestly, the most interesting thing I saw yesterday was this reaction, this bid that we saw across the Treasury curve in reaction to what we were seeing in the equity market. And I saw some explanations for why BMO was talking about the potential wealth effect, maybe taking some pressure off the inflationary landscape. I ran into Tom Keene this morning. He was talking about GDP ramifications. What do you make of what we saw in the bond market yesterday?
I think it's risk off. I think it's, investors saying, right, I'm pretty concentrated in equities, I'm concentrated in US equities, and I'm concentrated in tech. Where am I going to go? Where can I go for that more secure return? And I think that is one of the factors, the risk-off factors driving the bond market.
As easy as that, just that haven bid.
It's never that easy. There are other factors below the surface, but I do think that risk-off mood, that knee-jerk reaction, because the price action yesterday felt, let's do something rather than think about it. And a lot of that is also maybe baskets. People trading AI baskets that don't differentiate from a bottoms-up basis. And so I think when you're making those quick decisions, as I say, we weren't encouraging our clients to do that, but I think that is one of the drivers into the move in the Treasury market.
To Katie's point, I think about the 10-year and how the yield has climbed from 3.6% in September to as high as 4.8%. Yesterday, it dipped below 4.5%. Right now, at about 4.55%. With these big swings in Treasury yields, how do you price equities? I know that tech being its own story, its own secular story is one thing, but how do you price other parts of the market that are interest rate dependent?
I still think it comes back to the earnings story. So if we think about technology shares have obviously driven outsized earnings and cash flow and share buybacks, all of which is positive for the broad S&P. But obviously, we know large parts of that haven't participated over the last 12 months. So how am I going to price equities going forwards? I think we're looking to those other parts of the market, such as financials, still parts of the industrials market, that I think can drive the earnings growth as we go forward through this earnings season and through the balance of the year. And I would just say that I don't think that this is just a US equity story. We are firm believers in US exceptionalism in the economy, but that doesn't mean that you want a US only equity portfolio, because a lot of that good news is discounted, and we see what happens when positioning skews one way. That's what we got yesterday. And when you look at some of the nascent data coming out of Europe, the PMI is slightly better. I think the ECB will cut again, probably twice in Q1. Some of that will support, European equities as well as a positive shift towards China. If we get that, would also help. So global equity portfolio to me is the way to go.
That's really interesting. Just two quick notes there on financials. Actually, the financial sector hit an all-time high yesterday, Scarlett. Maybe an underappreciated fact given all the mayhem of yesterday's market.
Good point.
I want to continue that thought, though, on global equities, because I'll be honest, this show tends to be pretty U.S.-centric. We're right at the U.S. opening bell. So if you're taking a look at the global stock market, what is your allocation? You said that, you're U.S. first, it sounds like. But what does the breakdown look like by geography?
Yeah, so I would be overweight the U.S. for sure. But I think the mistake people make is that being overweight U.S. means let's not look at anything else. So within that, Japan, we think, is an interesting market. Why? Because it comes back to the income component. The share buyback story we still think is strong. There's a reflationary story in Japan that I think is interesting. So that would be second in the pecking order. And then Europe probably third. But I don't really want to take bets on these economies from a top-down basis. We know there are structural issues in both of those regions that I mentioned, but I think the themes are global. Whether we think about AI as a key theme, security is another key theme for us. Energy security, cyber security, supply chain security. These are global themes, I would approach it more in a thematic way rather than just a top-down taking a bet on the economy. And some of those themes can also be accessed in private markets, so infrastructure, which again can be US and actually European in that regard. Very interesting.
So that makes a lot of sense, but anytime you invest outside the U.S., you need to think about the currency impact. And we've had a very strong dollar. It's seen staying strong right now, even as there are increased forecasts for it to start faltering maybe in the second half of this year. How are you thinking through that exposure to the strong dollar?
Yeah, I still think the dollar is going to broadly retain its strength. When we think about growth differentials, it favors the dollar. Interest rate differentials favors the dollar. And as I say, in a risk-aware portfolio, I think the dollar is one of the ways people will think still about expressing their overall risk budget. What I would say is another asset that we think still is upside is gold. When we think about, not so much from the hedging the equity perspective, but I think gold in the portfolio is a good complement to.
It didn't play much of a role yesterday in the
advance. That's a good point.
It didn't rise as a safe haven.
No, but I think that when we think about deficit concerns and we think about geopolitical concerns, that's where the incremental buyer is coming in and where we think the interest really lies.
Yeah, it'll be interesting to see if gold comes back as a haven asset. Also, it'll be a fun science experiment to see what happens to the dollar if we do get universal tariffs. Grace, got to leave it there for now. Great to see you. That is Grace Peters of JPMorgan Private Bank. Now, coming up, watching shares of Boeing and JetBlue. We're going to dive into their quarterly results next. This is Bloomberg.
All right, it's now to high interest to look at what's making headlines around the world. The U.S. Immigration and Customs Enforcement expanding its raids to New York City. This follows a series of raids in Chicago. The newly appointed Homeland Security Secretary, Kristi Noem, joined an enforcement operation in New York this morning. In a post on X, she wrote that a criminal alien with kidnapping, assault, and burglary charges is now in custody. Denmark's prime minister is trying to drum support from European allies to stand up to President Trump's efforts to acquire Greenland. She met with Germany's Olaf Scholz in Berlin and French President Emmanuel Macron in Paris before meeting with the Secretary General of NATO in Brussels. Those meetings came after a viral photo of the prime minister dining with the leaders of Finland, Sweden, and Norway. And staying in Europe, UK Prime Minister Keir Starmer indicates he wants a better trading relationship with the U.S. He spoke with Bloomberg's Francine Lacqua and discussed his recent phone call with President Trump.
There's a huge amount of trade between our two countries. I think that's to our great advantage. I think that's something that we can build on. And so I was very pleased with the engagement that we've had with President Trump. We'll build on that.
And in the markets, Boeing and JetBlue both out with their latest results this morning. We're looking at shares of JetBlue tumbling after its cost outlook was higher than expected. Meanwhile, you've got Boeing's new CEO, Kelly Ortberg, saying he is realigning the company around key business lines after posting a $4 billion operating loss for last quarter. Joining us now for more is Bloomberg News' Brooke Sutherland. She is our Boston bureau chief, and she is also author of the Industrial Strength newsletter. Brooke, I want to start with JetBlue, given the tumble that it's seeing in shares today. Feels like this is a pretty large reaction. You might even say outsized reaction to the cost forecast, which was higher than anticipated. Put this in context for us, given that a couple of other airlines have reported already.
Sure. I mean, it's really just a continuation of this have and have not story in the U.S. airline landscape, where you see airlines like Delta and United that cater more toward premium flyers and have a larger international business, really sort of standing out from the pack and moving, further up the profitability curve, whereas the more domestically focused, lower cost airlines are really struggling. That's not as, a robust corner of demand for travel right now. And a lot of those airlines ended up over expanding in the wake of the pandemic and are now sort of dealing with that as we have sort of a glut of overcapacity on some of these more leisure-oriented routes. And then, as JetBlue talked about today, costs are going up. And when costs are going up and you have too much capacity, that is a dangerous equation. And I think you're just really seeing investors react to the continued travails of that corner of this airline market. And JetBlue in particular is really just struggling to find its footing after its 2 attempts at consolidating with other airlines to really expand its market share failed. That's, of course, the commercial partnership with American Airlines and then its attempted merger with Spirit that was blocked on antitrust grounds.
Yeah, absolutely. And with that in mind, given that we have a new administration in the White House, of course, it seems like investors are really enthusiastic about the prospect of a reinvigorated M&A market. Could we see JetBlue explore that route again, or have they just been burned too many times?
I think it might take a lot for them to jump back into the airplane consolidation game, just given their past experiences. And also, you know, M&A is always tricky, but it's particularly tricky in airlines when you're talking about merging 2 different brands, and that's certainly something that you ideally would like to do from a position of strength. And so, you know, I think JetBlue is probably focused right now on getting its own house in order, getting those costs down, ideally improving pricing, and seeing more of, you know, a stabilization in demand.
Well, given that shares have been so underperforming and JetBlue isn't exactly in that position of strength, Brooke, could we see them actually be a target here, or am I getting too silly?
I think, you know, the airline industry is highly consolidated, and this enthusiasm about M&A is certainly real and valid. But I think, you know, where you're more likely to see deals is perhaps outside of these already very highly consolidated sectors like airlines. You know, you can look at the past precedent, and the argument that antitrust advocates have made is that more consolidation is not always helpful in terms of consumer choice. And I don't know, you know, that argument is necessarily going to resonate a lot more right now. But there's certainly a lot of opportunity for M&A in some of these other sectors. But some of these highly consolidated industries that have already seen so much M&A, it might be trickier.
Yeah, and one of the reasons that JetBlue had cited for M&A was, of course, it wanted to increase its fleet, and it couldn't do so without a partner. Speaking of which, the company that makes those airplanes is Boeing. And we're looking at Boeing shares climbed to a 6-month high this morning. What are we hearing from Kelly Ortberg that has people feeling confident that it can deliver on the planes that are being ordered?
Remember that they pre-announced their numbers last week, which I think was helpful to Boeing to get some of the bad news out of the way. This was not, you know, a particularly strong financial quarter for the company as it dealt with the aftermath of that prolonged labor strike and the continued challenges with ramping up its jet output and getting its factories in better order. But what that enabled Boeing to do is really focus this earnings announcement today on looking forward, on Kelly's vision for remaking the company and really stabilizing it and putting it on a stronger footing. There were a number of charges in the defense side of the business. He says that they're clear-eyed on those challenges. It's worth remembering that we've heard very similar comments from Kelly Ortberg's predecessor, Dave Calhoun, you know, one of the last times that Boeing announced a slew of charges in that defense side of the business. And these charges just keep piling up. We also heard from Lockheed Martin today. They took nearly $2 billion of charges on some of their classified military programs. And so this is going to be a theme that's going to continue to play out for the defense sector as some of these companies grapple with fixed price contracts that were signed really without taking a lot of these inflationary pressures into account.
Well, looking forward to following your reporting on that turnaround. Our thanks, of course, to Bloomberg's Brooke Sutherland in Boston, breaking down a tale of 2 earnings. You have Boeing shares currently higher by about 6%. JetBlue suffering its worst day ever. Shares down by more than 23%. Now, still ahead, we'll talk about Microsoft joining the lineup of TikTok suitors for its U.S. operations. That, at least, is according to President Donald Trump. More on that next. This is Bloomberg.
The music industry is roaring, as you know. There's never been a time in history where ticket demand has been higher than it is right now for live music. And there's never been a time in history where the supply of new artists is higher than it is today. Live music is the #1 leisure activity in the world.
And that was Venue CEO J.W. Roth speaking to us on Friday morning on the boom he's seeing in the music industry. Enter CashorTrade. The fan-first social ticketing platform is leading the face value movement in ticketing. It's free from bots and scalpers, which artificially inflate prices. And here with more on how this business works is Brando Rich. He is CashorTrade's CEO and co-founder. Great to see you in person with us.
Great, thanks for having me.
So that was my quick explanation, but take us into how this actually works. If I have a ticket to a concert, I bring it to your platform, and I can either get money or some other trade for it?
Yep, you can either sell it or you can trade it for another ticket. Before CashorTrade is an app, it's a face value movement of fans coming together to buy, sell, and trade tickets at face value and to avoid scalping.
So how do you make money if it's face value?
So we have a escrow and insurance fee to help us protect all the tickets. And members also can become a gold member where they can avoid extra fees and purchase at cost.
What's the benefit of being a membership fee as opposed to just paying a transaction fee for each time you do make a purchase?
You gain a little bit more perks. You can reply right away to a post rather than waiting 10 minutes so you have the first dibs. But largely you can avoid any extra insurance costs and protection. You're just protected all year long.
So I want to go into your origin story because you're a big live music guy and you would travel the country attending live shows, including Fish, which is one of your favorite acts. And one of your frustrations was actually getting tickets. We all complain about the difficulty of accessing affordable tickets, but you went out and actually did something about it. What was your first step towards doing something about it?
Yeah, we were web designers. We got tired of seeing fans get ripped off, so we went on tour and set up a tent, and we actually had a bulletin board with Post-it notes.
A physical marketplace.
It's like our low-tech version. And everyone would come by and post up what they had for sale or for trade, and we would help them like safely trade tickets and avoid scalping. We took them out of the broker spotlight per se, and the CashorTrade platform allows sellers to choose who they want to sell to. So the way that the flow works, it's not like a click and buy website. You can't really just go on there and buy up all the tickets. You really have to communicate with the buyer or the seller, and they make friends, they leave reviews.
Oh, okay.
That's interesting. And so how do you grow this business and scale up? Because obviously you're dependent on people bringing their tickets to your site and your platform. So do you spend a lot of time on marketing? Is that really how you get the word out?
Yeah, we are building the face value movement. There's members from 46 countries and from every state in the US. But largely, there's this misconception that you can just run out on the scalper websites and make a bunch of money. And it's just not really that easy when you're paying 15% in commission fees, and then you see that your buyer may pay upwards of 35% just to purchase the ticket. And then you're competing with brokers who are sophisticated. Often people are just like, I just want to get my money back and pass it on to another fan who will enjoy the experience the way I would.
Some musicians, some bands have criticized Ticketmaster for their fees, their dynamic pricing. I'm thinking about Robert Smith of The Cure. Have you reached out to some of these artists who, look at the current system and say there's something wrong with it? Have they reached out to you? Is there any conversation going on?
Yes, we're partnering with a number of artists who are kind of fed up with the industry as well, and they really want to protect their fans. So they're directing people to CashorTrade as a way to stay out of the broker spotlight.
They're directing their fans, but they themselves are not getting involved with CashorTrade, are they?
We have worked with some where they've moved ticket drops or pre-sales through our platform to keep it to real fans.
Right. And of course, because of your background, live music is really your forte. That's where you operate. But how does this work with sports and sports teams that maybe might want to put a swath of tickets available on your marketplace and make it available at face value?
So we are building on our event database for sports. We've been primarily in live music, but the plan is to grow into sports as well. And then, as we work with events, mostly, they want to move tickets through the platform to keep it at face. But it's mostly an aftermarket platform than it is a primary. So it's really about when a fan can't attend anymore and they really just want to get their money back without sort of all the business dealings against brokers.
Right, and they don't want to deal with the vagaries of Craigslist, for instance.
Yes, the sketchiness.
The sketchiness.
These are real fans with real reviews, a history, a profile, and there's a chat application so you can end up communicating directly with them and build some trust.
All right, Brando, really interesting stuff. Great to meet you and hear a bit about the business. That is Brando Rich from CashorTrade. Meanwhile, we got to turn back to these markets because, again, we have a rally underway. The S&P 500 higher by about 0.4%, being led by big tech. The Nasdaq 100 higher by about 0.8%. What's remarkable to me is the volume right now. In the S&P 500 volume, 47% higher than the 20-day average. A lot of people coming in and buying this dip and buying the dip in Nvidia as well, Scarlett.
Yeah, although we have reached session highs and we've turned a little bit here, and volume is heavier than average. But for the Nasdaq, down 23% from the 20-day average.
Yeah.
So interesting.
That is an
the
interesting
volume
divergence.
burst is in the S&P 500 and more so in the Dow Industrials, which would seem to suggest that there's a lot of rotation going on here.
Yeah, absolutely. A lot of people sort of ripping up the script, similar to what we've done over the past 2 days. We'll continue to follow that. But we do have some movement under the hood as well. Let's get to some of the stocks moving this hour with Bloomberg's Isabel Lee.
Hey guys, I'm looking at AMD. It's kind of flat now, but edging lower. Maybe you can say 1%. The stock is downgraded to a hold by Melius Research. It says it sees earnings risk given the competition from NVIDIA. And the firm is also increasingly concerned that custom CPUs and NVIDIA CPUs will cannibalize even more of their server in the long run. And the firm has a 2-year price target of $129 for the stock. That was down from 160.
Okay, so some weakness in tech does continue. In terms of companies that rely on consumer spending, we know that cruise lines have done incredibly well, and we have another example of that today.
Yes, Royal Caribbean is popping 10%. The firm reported adjusted EPS that beat average estimates, and it extended its streak of profit beat. So the firm said its busiest booking period is off to a great start, and the busiest booking period is called the wave season, because wave season is when cruise promotions peak. This usually happens during the first quarter of the calendar year, and bookings have increased since their last earning call, and the company is also launching a luxury river cruise. So
of course they are.
I'd like to do that.
You know, wave season brings its own outfits with it as well. People get cruising outfits.
Oh, really?
Yeah, they're into that.
I mean, I do love a theme. I'm not a participant in wave season, though, the ocean. I don't know, not a place to be. Anyway, let's talk about General Motors. Interesting, good results, but sort of glossing over the potential impact of tariffs.
Yes, it's going the opposite direction, down around 10%. So they did have a better than expected profit outlook, but concerns about tariff threats really is weighing on the stock. Adjusted earnings before interest and taxes this year will range from $13.7 billion to $15.7 billion. So GM previously said that the 2025 profit will be in line with last year's total. But we have Morgan Stanley noting that the forecast doesn't even account for any of the new policy on taxes. Bernstein said it was unsure that full year guidance would provide much upside. So lukewarm there.
Yeah, the sell side really calling them out, and this move in shares. At one point, GM was down 9.9%. That was the worst move since March 2020. Not a superlative you love to see. Currently off by the most since November.
And worth noting as well that Ford shares are down about 3.2%. That company doesn't report earnings until next week, next Wednesday, but perhaps that gives some indication of what kind of forecast or not a forecast Ford might give.
Well, it's a good reminder, too, that these issues that we're talking about, it's an auto-wide industry sort of problem, not specific to GM, to Ford, or Stellantis, but all three of them. Isabel, great stuff, as always. That, of course, is Bloomberg's Isabel Lee. Now, coming up, Starbucks turnaround plan gets its first real test when it releases results after the bell today. More on what to expect next. This is Bloomberg. All right, Starbucks due to report after the bell today, which of course is the first real big test for the coffee chain's new CEO, Brian Niccol. He started rolling out new procedures to enhance the customer experience, including ceramic mugs for in-store customers, also unlimited free refills of iced or hot coffee. Joining us now is Daniela Sartori, who covers restaurant chains for Bloomberg. So we were just talking in the commercial break about how long it's been since Brian Niccol took over, because it feels like a long time. It's only been since early September. So with that in mind, I mean, what will investors be looking for both in the numbers, but also the tone of this earnings call?
Definitely. So as you said, Brian only joined in September. So really this earnings is more about getting a gut check about whether the business is headed in the right direction. A lot of the changes that he's implementing to make a face more welcoming, like for example, bringing back the ceramic mugs and the Sharpie so you can get a handwritten note on your cup, actually only came into effect officially on Monday. So yesterday. So it's less about his own plan and more about like, okay, Starbucks has already had 3 quarters of same-store sales declines. Does it get worse, or are we starting to see a stabilization? If it does get, if it is worse than expected, it might signal that Brian Niccol may need to do a lot more to turn the company around than what he has already said.
Right. And of course, he came to Starbucks with great fanfare. He has already been paid, I believe, about $96 million, according to filings. We know that he is able to work from Newport Beach, California, and kind of commute to Starbucks in Washington State.
All of this sounds great.
Well, nice work if you can get it. Daniela, my question to you is, in adding some of these small touches back, right? The ceramic mugs for customers, greeting customers, writing handwritten messages on the cups. All this costs money. How much patience will investors have for the spending that Starbucks needs to do in order to get the culture back on track?
That's a really good point, because as you said, he was already awarded $96 million, in total compensation. A lot of it is stock awards. And, he does commute, even though Starbucks has said that he spends, most of his time either traveling, visiting stores, or at headquarters. My sense right now is that investors are giving him time. I mean, he is what people say is a proven executive. He turned Chipotle around after, they had a string of issues, including, food contamination issues. And really, like, his plan is only starting to come to fruition, So for example, he has talked about improving the cafe experience and has already rolled out, some changes, but he has also talked about, for example, bringing back more comfortable seating. That's not the type of thing that you do in 3 days. It's the type of thing that really, you have to plan for, maybe even remodel stores. And actually just today, as Starbucks announced the appointment of one executive that would be in charge of store design.
Right.
So really he's just getting started. So there's a chance that it might be, maybe a year until we actually see changes.
We'll talk a little bit more about that. Of course, we're talking about the physical stores and ceramic mugs, but let's talk about leadership, because you wrote up this morning about how they're shaking up the executive ranks further. They are, of course, seeing their president of North America, also their chief supply and customer solutions officer leave. Again, Brian Niccol, he's been in the seat since early September. How much more turnover can we expect at the executive level en route to this turnaround?
Probably more. We do know, and Starbucks has announced that, they will be rethinking the corporate structure as part of, Brian Niccol's plan to turn the company around. And there will be layoffs that will be announced by early March. It could be rank and file, but it could also be just a rethinking of the top ranks, just like what we saw today. And really the emphasis today was on what they call the retail team, which is the stores, right? The people who are ultimately in charge of how stores perform. And so he's rethinking those roles. And he was like, okay, we're going to split a couple of these roles to make sure, in his words, that there is more, clearer accountability for how the stores perform. And, basically when he came in, like, as early as, October, he was already making some changes and undoing some of the leadership structure that his predecessor had installed only a few months earlier. So I do expect to see a lot more change coming to Starbucks, maybe top ranks, but also, the rank and file in the months to come.
One question I got to ask you about is China, because although North America and the U.S. in particular is Starbucks' biggest market, China has been a source of concern for a lot of investors. And the argument against Brian Niccol, who has a tremendous track record, is that he doesn't really have that international experience, having been at Chipotle. What is Starbucks' stated strategy in China right now to get things back on track?
Yeah, that's an excellent question, because basically what they have said is that they are reviewing the business, right? They're reviewing the best way to run it. So right now, North America and China run the same way, which is that for the most part, Starbucks runs the stores directly. In other international markets, they actually have like a licensee. Imagine that, like, someone pays you for the right to run the stores and they run it themselves. And China operates that way now, but there's been questions about whether that's the best model. And, and Bloomberg has reported about, Starbucks looking at several options for that. We can say, too, that there's been a little bit of a leadership transition there. So the person that had been in charge of the business business for a very long time. Transitioned first to like a chairwoman role, and now there was a recent announcement that she's retiring. There's a new leader in place. So I think investors are going to be looking for a lot more clarity and hopefully more information on today's earnings call about the China strategy. But there's definitely already been some movement there.
All right, Daniela, really looking forward to those earnings results after the bell. Looking forward to your reporting as well. That is Bloomberg's Daniela Sartori. And I have to say, Scarlett, I have one piece of free advice for Brian Niccol, if he's watching, which I assume he is. The food at Starbucks. I don't know how often you're pulling out your app and ordering food at Starbucks, but
you're not into it?
It's pretty dismal. They do have this egg bake that I like a lot, but other than that, I mean, it's pretty slim pickings there.
You know, they've gone through a lot of changes. It feels like they were trying to do a lot more, and then they kind of streamlined things. So you almost don't know what you're going to get when you go there.
That's true, yeah. But I don't need a ceramic mug. I just need a nice egg sandwich. But in any case, coming up, the Trump administration has directed federal agencies to pause federal funding, including grants and loans. We'll have details on that move next. This is Bloomberg.
The Trump administration is directing a broad pause in federal spending. This includes grants and loans. It's obviously pretty wide-ranging, so we want to get more details and bring in Bloomberg Balance of Power co-host Kelly Lyons. Kelly, I say we want to get more details, but do we actually get more details? Because so far, the MO of this administration is to say big, broad things and then kind of let details dribble out later on.
Yeah, Scarlett, there is a lot we still don't know at this stage about how sweeping this ultimately is going to be. It was only a 2-page order that was issued by the Office of Management and Budget yesterday, but it could have widespread ramifications for organizations across the country. We're talking tens of billions of dollars in government spending that, at least for now, is going to be paused. They say that won't affect individuals who receive payments through things like Social Security or Medicare, but it could affect NGOs. Charitable organizations, research institutions, and universities all could see their funding paused, effective at 5 p.m. this evening. This is a very short notice. Of course, the Office of Management and Budget said these organizations that have their funding paused because they don't align with so-called presidential priorities and the executive orders we've seen Donald Trump sign in his first week and change in office will have until February 10th to submit a report to the OMB, try to restore that. But there's just a lot of questions at this stage about what organizations exactly will be affected and frankly, whether or not this is legal. A law passed by Congress in 1974 puts constraints on the way in which a president can pause funding that has been appropriated by Congress. All of the funds we're talking about here went through the legislative process, got congressional approval, and it's not clear what executive authority there actually is to go against Congress in that way. So this is something that could very well end up in the courts. In fact, the administration may be looking for the Supreme Court ultimately to weigh in on this constitutional question here.
And Kelly, I also want to get your thoughts on the confirmation hearings that we have this week. This is some breaking news on RFK Jr. He said that he's not anti-vaccine or anti-industry. This is according to prepared testimony seen by Bloomberg News. Quote, all of my kids are vaccinated, and I believe vaccines have a critical role in healthcare. So interesting there from RFK Jr. Ahead of those confirmation hearings, what are we expecting? Because we have RFK Jr., I know we have Tulsi Gabbard and Howard Lutnick as well this week.
Mm-hmm. Howard Lutnick is probably going to be pretty smooth sailing, as we saw with Scott Bessent. Katie, there does seem to be a degree of bipartisan support that could be there for his confirmation. For RFK Jr. and Tulsi Gabbard, though, whose hearings are today and tomorrow, respectively, it's going to be a lot tougher. RFK, as you alluded to, is going to face a difficult line of questioning around his views on vaccinations and his repeated suggestions, although there is no evidence to this, that vaccines cause autism. So he could be getting a lot of that from Democrats especially, but he also could face pushback from conservatives on his views around abortion. And that is one of the reasons why it could be difficult for him to get the requisite votes in the Senate to be confirmed. A lot will depend on his answers in his testimony. For Tulsi Gabbard, she's facing a litany of questions around her trip to Syria back in 2017, her relationship with the now ousted dictator Bashar al-Assad, her past refusal to support Section 702 of FISA, foreign surveillance that impacts people in the U.S. So she has a lot of national security hawks who are very concerned about her ability to be the director of national intelligence. And she cannot afford to lose a single Republican vote in the Intelligence Committee that will hear from her tomorrow. And so we're going to be watching very closely to see kind of the demeanor of those who are questioning her, because she is seen as the one with the steepest hill to climb if she does indeed want to be confirmed.
And very quickly, Kaylee, I understand the White House will hold its first press briefing today at 1 p.m. Eastern Time. Are we likely to get any clarity on tariffs? Because President Trump has indicated that he wants across-the-board tariffs that are much bigger than the 2.5% that reportedly Scott Bessent, his Treasury Secretary, has floated.
Yeah, that's what the president said on Air Force One traveling back from Florida last night. He said to protect America and, of course, American manufacturing, he would like to see a universal tariff of higher than 2.5%. But he didn't get specific about that number or a timeline, though we are watching Saturday, February 1st, as he said that could be the day in which he implements 25% tariffs on everything coming from Canada and Mexico. But Caroline Leavitt, the youngest press secretary in history, mind you, at just 27 years old, will have to face those questions from reporters at 1 p.m. Eastern Time today. We'll see if she's willing to get ahead of the president at all, if she dodges that until Donald Trump gives us firmer answers as to what exactly he would like to see implemented and when it comes to those levies on foreign imports.
Yeah, some must-see TV there, Kelly. I know you'll be all over it. Our thanks, of course, to Bloomberg's Kaylee Lines in Washington. And tonight, Senator Dick Durbin from Illinois will join Kaylee and Joe Matthew on Bloomberg Balance of Power. Meanwhile, a quick check on these markets at session highs right now. In the S&P 500 higher by about 0.6%. The Nasdaq 100 higher by about 0.8%. We'll see how that develops between now and 4:30. But that does it for us for now. I'm Katie Greifeld alongside Scarlett Fu, and this is Bloomberg.